So yeah, so guys, today's focus will be on basically doing questions which is to do with um, national income accounting, and also we'll try to do some questions on national income determination. So remember, we have two separate discussions: national income accounting and national income determination. So let's look at a couple of questions which is to do with national income accounting. I want to look at first of all this one. Um, it is difficult to calculate the value of GDP, and it does not provide an accurate measure of the welfare or happiness of a country's citizen. Therefore, it should not be used as an indicator of the standard of living. So, if they're saying this kind of question, uh, it's a very commonly tested question, which is basically looking at why is it difficult to calculate the value of GDP? Like the keyword is value of GDP, and the why does it not provide an accurate measure of the welfare or happiness of a country's citizens? So, and therefore, why is it not good as a standard of living for a country? Okay, so in this kind of a question, we're looking at our discussion that we had previously, which was to do with whether GDP is a good measure of welfare or not. So let me quickly go to that discussion from our notes so that then I can come back and review this. So guys, in this question, we will basically, if you look at the notes, we are going to focus on whether GDP is a good measure of welfare or not. So when you look at this discussion, remember, if you get a chance to read the notes, we said this that we use uh, real GDP per capita as a measure of a comparison of performance of countries' GDP, various countries' GDP. Real takes into account inflation, right? And per capita, I mean, takes into account your population. For example, one country might have a high population, another country might have a low population. So therefore, per capita would mean you get an average per person. And also sometimes you adjust it for purchasing power parity. So there's a purchasing power parity adjusted thing that happens where since you're expressing everything in terms of dollar, by adjusting your interest rate, your exchange rate for purchasing power parity rate, you are able to then also take into account the cost of living in each country, or in other words, the the purchasing power in each country. So, what is the commonly used yardstick for comparing performance? And the answer is real GDP per capita purchasing power parity adjusted. Right now, when you look at it, so if you go back to the question again, just to go back to the question, so when you look at this question, they're saying it is difficult to calculate GDP, value of GDP. So first you need to tell them about what do we use to measure, and we use real GDP per capita PPP adjusted, purchasing power parity adjusted, right? Now, when you look at real GDP per capita purchasing power parity adjusted, there are two kinds of problems that you will see happen. Number one, it does not it does not include all output, right? And number two, even if it does include all output, it is not a good indicator of welfare. So in a way, you are discussing two parts of it. Why it's difficult to calculate the value of GDP. Number two, why even if you do that, it's not a good indicator of the standard of living. So what are the things that are missed out on in the calculation of GDP? We say things like, for example, do-it-yourself activities like voluntary work or do-it-yourself uh, things. So, for example, do-it-yourself uh, activities. For example, I decide to fix my car and not take it to the garage to get it fixed. Would be do-it-yourself activity, which means there is an output that is produced, but it's not recorded. Similarly, like so work by homeowners. Like if you're a homeowner, if you're doing your own work, that would be not included. Similarly, voluntary work will not be included. Voluntary work will be missed out, because although it's something which you're doing, you're not really asking for money. Or underground economy, the hidden economy, the informal market will be also that output that will be missed out in this thing. And lastly, even like your public service, public sector outcome. Public sector is government. Like if the government is trying to sort of look at or police, for example, if you look at these sectors, they are sort of we do costing at we could we do pricing at cost. So let me write this: pricing at cost. And therefore we don't really take into account some what we call the market value or productivity value, and sometimes that could be also problematic. Make sense? Any questions before we move on? So mention the idea that your GDP per capita does not capture all the output that is produced in an economy, because either it misses it out because it's a non-market. By the way, this is called, all of these, the first two are called non-marketed items. Non-marketed items means they're not bought and sold in the market. Make sense? So they're non-marketed items, and that's why you miss them out. Similarly, underground economy also miss it out, because again, it's not sold because it's illegal to. It's sold, but it's illegal to account for it. Make sense? So underground economy may include prostitution, may include drug selling, may even include informal sector.
Sir, I have a question.
Yeah.
So where does subsistence production go then?
Subsistence
Like, does it go
farming,
under
underground economy? Yeah, underground economy.
Yeah.
Yeah, because there's no
But
transaction.
it is dealt in the market.
It is.
But the transaction is happening in the market.
Exactly, but no one reports
but
it.
It is not recorded, just.
Yeah, recorded or reported. Yeah, exactly. Similarly, GDP is not a good measure of welfare. Why? Because there could be externalities which are missed out. Remember, what are externalities? Externalities are third-party costs and benefit for which people are not compensated. For example, also, like some things can make your GDP to go up, but may not really improve standard of living today. For example, if a country does investment today, right, does it improve your standard of living today? No, it will improve standard of living tomorrow. So investment today can make the GDP to go up, but may not increase standard of living today. It may do so tomorrow. Another important part that we say is that what about what you call it, exports? Remember, C plus I plus, so AD is equal to C plus I plus G plus X minus M. So I go up, AD go up, GDP goes up, or or for example, X goes up, GDP goes up. But exports go up. Who consumes that export? And the answer is, this export is consumed by not people in this country, but people outside. So outsiders may have a standard of living to go up. So one argument is, but money comes into the country, and so that when the money comes, maybe people can buy from that money, and therefore their standard of living can go up. It is true, that could be possible, but not necessarily that you can say this, that your standard of living go up, your standard of living may not go up, but standard of living can go up for foreigners. So a good example of this is that, Pakistan make very high quality mangoes as well. Maybe Bangladesh also makes it, I don't know. But let's say Pakistan makes high quality mangoes, but those mangoes are actually exported. Local market hardly gets it. And therefore, while Pakistan is making very high quality goods, but this is going abroad. For example, also one more thing, since you guys are from Bangladesh, you would know this, that Bangladesh is exporting a lot of clothes abroad. So anytime I'm buying clothes from Gap, or for example from other, it's all made in Bangladesh. So so you might be from Bangladesh, you might not be wearing Gap, in Bangladesh, but when you go abroad, you buy a T-shirt, it is made in Bangladesh. So in a way, you find it funny that you don't find that good in your country, but you may find it abroad. Make sense? So that's exports is basically making the standard of living of foreigners to go up. Another argument we raise, where we say that standard of living is probably sort of not taken into account in your GDP, is to do with what you call it. Let me just take it out quickly. It's to do with it's to do with your quality of goods and services. So a good example of this is that, what if a new iPhone comes in market? Okay, if a new iPhone comes in market, and that new iPhone is basically uh, double, two times the quality, right? But only 1.5 times the price. In this case, although the quality is going up, but the price isn't really going up. GDP will only think that the price has gone up, and therefore will not take into account the quality part. For example, like cars now are much, much superior than the cars 80 years ago. But also, cars relatively are much more cheaper than 80 years ago. But that doesn't really mean cheaper car means lower quality. Cheaper car means better technology, and therefore the price is not an indicator of your quality. So the quality of goods and services are missed out by GDP calculation because it only looks at things at prices, and it doesn't really look at quality per se. Make sense? So that's an argument that can be made against GDP per capita. Lastly, I mean, we can also say this, that the distribution of income can be very unfair. A good example of this is Qatar has a probably one of the highest GDP per capita, but when it comes to distribution of income, one may argue it may not be fair as compared to, let's say, Luxembourg, or as compared to, for example, Switzerland, where the distribution of income could be, or Finland, where the distribution of income could be much more fairer and could be a good reflection of your GDP per capita, being a good reflection of your standard of living. Make sense? So distribution of income can be unfair, and that could be a problematic thing to happen. Are we good? Does that make sense? So you can write about distribution of income. You can talk about what you call quality of goods. So this is kind of like an outline for your question, which is this one. And also, if you see, um, this could also be answer of assess how appropriate to use economic growth as an indicator of standard of living. Similar answer that you will write here. Similarly, look at this one. Estimates in 2015 put the GDP of New Zealand at 191 billion, Peru at 190 billion, and Romania at 189 billion. Are these figures a sufficient indication? I think that the standard of living in the three countries are very similar, and you need to say that we need to find. First of all, you need to say we need to find real GDP per capita. Because what if New Zealand population is really small, which is the case probably, and as a result, this 191 billion could be at a, so real GDP per capita PPP adjusted should be found rather than simple real GDP. And then when you find that, then talk about whether is it still a good measure of standard of living for a country. Make sense? Are we good? Any questions?
We're good, sir.
Are we good to move on?
No, sir, got it.
Okay. So another thing that we can talk about is this one, which is basically talking about explain how GDP is calculated and show how GDP at market prices is different from net national income at factor cost. So here, there's a formula, right? GDP at market prices versus GDP at factor cost. The question is saying, let me just tell you because it's a 12-mark question. How GDP is calculated, you can talk about, there are three methods. You can talk about first the three methods. The income approach, the output approach, and the expenditure approach. Right, so these are the three things you can mention, the three approaches that you can mention. uh, and the discussion is there in the notes, so don't need to worry about that. And then you need to talk about basically uh, how GDP and market prices is different from the net national income at factor cost. So uh, so there are two discussions that we're looking at. Number one is net national income, which means this one. So when you have GDP, right? From GDP, you need to convert it to GNP, and GDP plus net property income from abroad will make it GNP first of all. And net property income from abroad basically means all the income that is of your residents, or let's say Pakistan's residents, or Bangladesh's, let's talk about Bangladesh's residents who are living abroad. You add all that income, uh, while subtract all the income of foreign residents in Bangladesh. So, for example, let's say if I'm a foreigner who's working in Bangladesh, then the income that I make will be subtracted, because although I am making this income in Bangladesh, but I'm a resident of another country. So net property income from abroad is the income which the country's resident earn on their physical and foreign assets abroad. So let's say if you're from Bangladesh and if you're owning an apartment in, let's say, UK, the rent that you get, we will add that in this net property income, but we'll subtract all that income that probably somebody who is foreigner who owns an asset in Bangladesh to get the GNP. So GNP is basically a measure that gives you the income of a country's resident. Number one. Then they say, because they said net national output, so you need to subtract capital consumption. Capital consumption is basically replacement. We call it replacement investment, or like depreciation. So you subtract that also from your GNP to get NNP. So that's your second step. So if I go back to the question, they're saying this, that show how GDP at market prices is different from net national income at factor cost. I'm going to talk about factor cost and market prices in 1 minute. First, I will convert my GDP to NNP, net national income or output, right? So that's first step that I've done is this. Then I'll be like, okay, what about the market prices versus factor prices? Remember, factor prices is when the thing goes out from the factory. Versus market prices is basically you are looking at two things to happen. So you look at this, guys. GDP at factor cost. Just 1 minute. GDP at factor cost is equal to GDP at market prices. So let's say what you get from the market. Let's say a Pepsi bottle is sold for not a good is sold for $40. Let's not mention the name of a product, but let's say a good is sold for $40. I don't know whether you can see this. Sorry, a good is sold for $40. You subtract all the indirect taxes. Let's say government decides to put an indirect tax of $10, so you subtract that. Why are you subtracting indirect taxes? Because indirect taxes are artificially making the price of the good to go up, right? So the good might be for $30, but because you put a tax, you made it $40. So you subtract indirect taxes and you add all the subsidies. Let's say the government gave a subsidy of $15. When I do that, 40 minus 10 plus 15 means 40 plus 5, which means $45. This $45 is what we call the factory cost, the factor cost, the cost at which you made that good. So you artificially basically made the good price to go up through indirect taxes, and artificially price was reduced through, so you fix that. So if you go back to the question, so you'll say this, that from GDP at market prices, I will subtract indirect taxes, and I will add your subsidies, and that will give me GDP at factor cost. And this GDP at factor cost will be useful for me because that is what is truly cost me to make that good. You know, that is what is truly cost me to make that good. Are you all with me? Does that make sense? And then, of course, from GDP at factor cost, you will you will add net property income from abroad to get your GNP, and then to get your NNP, you will do GNP minus capital consumption or depreciation. Okay, so that's the story. Let me change the setting of this because I think you guys are unable to see it. Any questions before we move on?
Sir, I
No.
have a question about GDP at factor cost.
Yes, please.
And how do I relate this to this question? Like, where do I bring this point in?
See, look at this. What is they saying? They're saying explain how GDP is calculated and show how GDP at market price, GDP at market price is different from net national income at factor cost, which means first GDP at market price needs to be converted to GDP at factor cost. Then GDP at factor cost needs to be converted to GNP, which means GDP plus net property income from abroad. Then GNP is calculated to NNP, which is GNP minus depreciation. So you'll say that GDP at market prices needs to go through some calculation to find you for you to find out NNP. So that's what they want to know whether you know the idea that GDP's factor cost is different from NNP by adding your net property income from abroad and then subtracting depreciation, you will be able to find yourself NNP at factor cost. Got it?
Sir, I have a question,
Yes,
sir.
sir. Thank
So
you.
why do we always have to convert GDP at market price to factor cost?
Well, you don't have to always, but in order for you to have an answer that relates to all the three approaches, you may need to do that. Like income approach, output approach, expenditure approach will give you the same answer only when you find them at factor cost. So this is your output approach where you change this to get yourself an answer that matches with the income and expenditure approach. So that's why you need to find GDP at factor cost. Make sense? So these questions,
Yeah.
guys, are a
Yes.
good way to look at what do we need to prepare for in that chapter that we just talked about. So when you're doing this chapter, you may need to make sure this idea that we just talked about. Okay. Any questions? Because I'm going to move on to another discussion.
So here number 4 question is also similar, right? How
Mhm.
economic growth measures the standard of living.
Yeah, but here I'll just define economic growth, uh, which is the change in real GDP, then talk about why it may not be a good measure despite using GDP per capita, but still it may not be good because of the reasons we just mentioned.
Okay, sir. So we'll just start with real GDP per capita with purchasing power parity. Like we do not need to write about GDP and then real GDP, then real GDP per capita. We will start with real GDP per capita
Yeah, we
from
will.
the start.
Yes, we'll explain
Okay, sir.
why real
Okay,
GDP per
thank you.
capita could be a good way to go forward. Make sense? So this is I mean, easy chapter because it has this kind of a thing. Now I want to talk about one of you was saying something about like accelerator. Somebody was asking for about accelerator.
So yes, me.
Yeah, accelerator and anything else that you have which is sort of confusing or needs more clarity from the national income determination chapter?
No, sir. Only this one,
Okay,
accelerated thing,
so
and a little
let's
bit
talk
of
about
multiplier.
okay. Let's talk about accelerator, and then we talk about some of the important stuff that I want you guys to prepare. At least we have whatever time we have, we can revise the accelerator idea, which isn't that tricky. Basically, accelerator, there are two kinds of theories that we're looking at. One is the Keynesian thought, the model that we said AE is equal to C plus I plus G plus X minus M. So AE was equal to C plus I plus G plus X minus M. And we said this whenever I goes up, your GDP or Y goes up, national income goes up uh, via the multiplier. What is multiplier? Multiplier basically is the extent to which your national income rises when you change any of the components of aggregate expenditure, which is autonomous. So when your if your multiplier is 5, let's call M as multiplier as 5, right? If your multiplier is 5, and let's say I was going up by $100, your national income will go up by 500. Okay, so this was Keynesian view, which says this, that uh, national income can be changed by changing, for example, investment or consumption or whatever, but let's say investment, right? Because we're about to discuss accelerator, which is an investment theory. So when you want to change national income, you change investment. And investment, if you increase investment by, let's say, 100, national income will not increase by 100, but will increase by more than 100 because of the multiplier. Multiplier helps us because one single investment will take multiple rounds in the economy and will keep on generating more jobs than $100 worth, but it will be more output than $100 worth will happen because of a single investment of 100. So this was Keynesian view. Then came the accelerator view. So the accelerator view is slightly different. In fact, different accelerator theory actually said this, that you know what, investment is dependent on national income is dependent on investment. You know that this one was saying this, that Y is a function of I. You get it? Like when the I go up, then Y go up. So this is your Y variable, this is your X variable, in other words. But the accelerator theory says no, but what we say is that I also is a function of Y, which means when the national income go up, then there is a possibility there could be more investment can take place, and that can make I to go up, investment to go up in the economy. So the accelerator theory was based on this notion that, you know, like investment is equal to some alpha times change in Y. So alpha basically is a variable, is a kind of like a slope or gradient or a factor, which is basically your capital output. It's called also capital output ratio. So for example, if investment changes by, let's say, $100, right, and your alpha is like 4, then national income changes by $100, and if alpha is 4, then investment can also increase by 400. What is happening here, guys, is this, that your investment is going to rise because suddenly firms will realize that the change in your output as compared to last year is more. In other words, let me write this in words also. When output, and this theory is very particular about this, that when output or income or GDP is rising at an increasing rate, if it's rising at an increasing rate, then you may see your investment to go up, because that will basically be helpful for firms, right? So the idea goes this, that this theory is slightly different from the Keynesian theory. They can come together as well, which is another discussion I can spend some time on that. But before I move on to that time, I want to show you this. Sometimes an MCQ comes which says this, that this is your Y. In fact, this is your I, and this is your change in Y. And they make a line like this. And they say this, that this is when the investment is going up, your I is going up, and the slope of this line, the slope is alpha. Okay, so that is an important thing to remember. Any questions? Because I want to show you, maybe I can have a question somewhere which can actually exactly talk about accelerator. Let me know before I find that question. Yeah, look at this one. What does the accelerator principle state? Can you guys answer me this question?
So C, investment is a function of the rate of change of income.
Exactly. Investment is a function of the rate of change of income. Okay. So when income changes, investment changes by some alpha, some factor alpha. Make sense?
Yes.
Okay, one more question I could look at. Okay, what is the basic assumption underlying the accelerator theory?
Investment depends on the level of business confidence.
No. It's actually C again. It's the rate of change of consumer demand, means people are demanding more goods, means more investment will happen. Okay. One important thing, guys, I want to talk about, and I want you guys to go back and prepare this for me, is this question. Like, it's an essential question. Let me find it out quickly so you know exactly what we're talking about. I want you guys to make sure you know this question. Okay. So tomorrow when we meet, we will pick our discussion, but I want you guys to make sure when you go back, prepare this one for me. And also B part. Let's discuss B part also, but prepare that for me. Like, be ready for a discussion on this straight from the notes. Will you do that? Does that make sense?
Yes, sir.
Okay, sir.
Okay, sir. Yes,
Okay.
sir.
And we'll end our class on this note, and then we'll sort of discuss tomorrow.